Ladies and gentlemen, good day and welcome to the Q1 FY25 earnings Shalby Ltd conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kashish Thakur from Elara Securities Private Limited. Thank you, and over to you, sir.
Thank you, Sabha. A very good evening to all of you on the call. On behalf of Elara Securities, I, Kashish Thakur, welcome you to the management call of Shalby Ltd to discuss Q1 FY25 earnings and business outlook. We have the top management team of Shalby present in the call. I'll now hand over the call to Mr. Jigar Todi from IR team of Shalby for his opening remarks and taking it further. Over to you, Jigar.
Thanks, Kashish. Good afternoon, everyone. Our earnings presentation is uploaded on the stock exchange website and our company website, shalby.org. We do hope you have already had the opportunity to go through the presentation. Please note that some of the statements made in today's call may be forward-looking in nature and may involve risks and uncertainties. Kindly refer to slide number 37 of the investor presentation for a detailed disclaimer. Now, I would like to hand over the call to Chairman MD Dr. Vikram Shah for his opening remarks. Thank you, and over to you, sir.
Good afternoon, everyone, and a very warm welcome to the earnings call of Shalby Ltd. I am pleased to announce that the company has maintained consistent performance across the key operational and financial metrics. We are present in Gujarat, Western India and Northwestern India. And we are the biggest in Ahmedabad, we are biggest in Gujarat in the corporate hospitals, and we are biggest in Western India in corporate hospitals. With our recent acquisition in Delhi, it is going to make a huge difference for us for international business, as this hospital in Delhi is doing 70% of its work international. And they are leader in liver transplant, bone marrow transplant and kidney transplant, and also onco surgeries. Now onwards, our more focus will be beyond joint replacement on cancer, onco surgery, onco medicine and radiotherapy, and we are going to invest some amount in radiotherapy machines also. Also, transplant surgeries, we are going to increase across the group. As you all are aware that we are number one corporate hospital group in joint replacement surgeries across the world. And we are maintaining it for last 20 years. And we will continue to maintain it. As far as these quarter's results are concerned, I am very happy to announce that our company has done great job. And all our senior people are here and they are going to take you through results now onwards. May I introduce Deepak Anantkrishnan, who is head of our implant business. He will take you through implant business now.
Thank you, Dr. Shah. Good afternoon, everyone. During the first quarter of this financial year, our implant business made significant progress, generating revenues of INR 259 million, up by 58% growth, with contributions from the US and OUS at 44 and 56% respectively. We are actively focused on bolstering our team with skilled professionals, transitioning our sales mix to retail customers, enhancing operational capacity and efficiency, expanding our product pipeline through extensive research and development efforts, and significantly reducing procurement costs. The reception of our Shalby advanced technology implants in hospitals across all markets that we have launched has been highly positive, and we have received additional orders from the Indonesian market. With our key strategies firmly in place, Our team is fully dedicated to executing these plans flawlessly. Shalby is well positioned to achieve double-digit growth with sustainable profitability, while also expanding and deepening our presence by opening up new geographies. These efforts will ultimately drive the creation of sustainable value for all stakeholders at Shalby. Like I mentioned last time, the 4 different pillars that we are focusing for the year. Number 1 being sales. Sales in the US is looking at coming on board to get to an $8 million from the last year's number of 4.8 million for the year. We are looking at getting to this by onboarding more distributors, sales team, as well as marketing efforts. We are also talking about participating in large congresses, initiating digital marketing, etc. OUS sales, we're looking for another $8 million with the right products across Southeast Asia, Latin America, and other countries where reimbursements are higher than India at this juncture. COGS reduction is the second pillar. Looking to end the year at a COGS of 50 to 80% reduction across portfolio by improving efficiencies, shift times, processes, new vendors and suppliers onboarded. This is an 8 to 12 month project, but actions have already been taken and things have started to show up, including the current quarter that went by. The third pillar being capacity. Currently we are dependent on one vendor or one supplier for every material, and hence its cost is high as well as business can get affected when our supplier has issues. So we are planning to have a multi-vendor system with higher capacity contributing to a sales forecast. With higher volume commitments to double our sales, we have initiated and onboarded new vendors with lower costs as well as increased capacity. This will also help us protect business continuity. The last one is new product. This team is looking at working for today, next year and 2 years down the lane. We already hired the head of engineering and the team is being built, and also surgeons are being onboarded to support the new product initiatives. We have also initiated and formed SAT India, where already we have started including on hiring engineers in India who will be working on some of these new product developments. Split into 3 parts. The new product is around, there are products which we will have to build from scratch, like our Gold, which is already gone for US FDA approval. Ambition, where we've already got the FDA approval for the implant, but we're waiting for the instruments to come through. And then eventually our Tux Gold, which is expected to launch. We're also building improvements in the current system, right from adding additional SKUs in the current product, improving our instrument set. We're looking at a huge growth coming in from the ambulatory service centers, which are called ASCs in the US, and hence to create the system to cater to the same. More sleek and improved instrumentation needs to be done. This will all increase our sales of our current product. Every new SKU still goes through a wear test and regulatory test approval and needs to go through a whole FDA approval process. We also have a new design product initiative, which is in terms of building a revision knee, revision hip portfolio, dual mobility, medial knee. All of this are 2 to 3 years project if we kickstart the work this year, which we have already initiated with the engineering team. So with sales growing up, COGS coming down and capacity built to drive growth, I think we are home. New products are important to make sales grow from short as well as long term, and also put us in good spot from an innovation standpoint. With this, I would like to hand over the call to Mr. Amit Pathak for company's performance in this quarter. Over to you, Amit.
Thanks, Deepak. Good evening, everyone. I am pleased to welcome you all to the Shalby Q1 FY25 earnings call. Now I will walk you through the financial performance of your company for the first quarter of FY25. The consolidated revenue of 289 crores for Q1 FY25 versus 240 crores in Q1 FY24, and we have been grew by around 20% on YOY basis. This is the highest ever revenue what we have clocked in the history of Shalby on the consolidated level. EBITDA of 55 crores in Q1 FY25 versus 48 crores in Q1 of the same period, with the margin of 20% in the current quarter versus 19% in Q1 FY24, and we have grew by 15% on YOY basis. PBT of 30 crores in Q1 FY25 versus 33 crores in Q1 FY24, and we have been degrew by 8% on YOY basis. PAT of rupees 15 crores in Q1 FY25 versus rupees 21 crores in Q1 FY24. Our YOY basis, our performance excluding the Sanar business, which has been acquired into the last quarter, that is the quarter 4 of FY24. So if you will exclude the Sanar business, on YOY basis, our consolidated performance, the sales has been grew by 10%, EBITDA by 16% and PBT by 10%. So the degrowth in the PBT on the consolidation level due to we don't have the comparable number of Sanar into the last year of the same financial year. The group continued to maintain a very strong balance sheet with the low gearing ratio of 0.18x, which is on the equity of 909 crore with the net debt of 168 crore. Now I will run you through the standalone performance of the hospital business. Standalone revenue of 240 crores, which is the highest ever revenue on the standalone basis into the last 30 years. In quarter 1 FY25 versus 216 crores in the quarter 1 FY24. And we have grew by around 11% on the hospital business on YOY basis. EBITDA is 58 crores in quarter 1 FY25 versus rupees 50 crores in quarter 1 FY24 with a margin of 24% in the quarter 1 of this year versus 23% of quarter 1 of the FY24 quarter 1, and we have grew by 17% on YOY basis. PBT of 46 crores in the current quarter versus 40 crores in the same period of the last year, and we have grew by 15% on YOY basis. And PAT is at 31 crores in this quarter versus 26 crores in the Q1 FY24, and we have grew by 16% on YOY basis. At standalone level, again, we continue to maintain a very strong balance sheet with a positive net cash of 63 crores. And on the operational side, from the hospital business, which includes the Sanar business also, the inpatient and outpatient and surgery count has been grew in the range of 10 to 13% on YOY basis. ARPOB and ALOS has shown a significant improvement, and our ARPOB is 43,365 and ALOS is 3.7 respectively compared to 38,000 and 3.97 in the same period of the previous year. ARPOB on YOY basis has been grew by around 14%. The number of occupied beds has increased over 7% on YOY basis, and the occupancy rate of 48% in the current quarter due to acquisition of Sanar. Occupation at Shalby Ltd, excluding Sanar, has remained at 50% in both the period, that is into the current year and same period of the last financial year. The payer mix for the entire hospital business, for the self, it is around 35%, insurance 41%, and government business is 24%. Now from investment point of view, our capex for the acquisition of Sanar is concluded, and in future capex will be incurred for the capacity expansion of 130 beds to 200 beds into the coming year from the Sanar prospect. Post our acquisition in Q1 FY25, Sanar has contributed top line of 23.77 crores versus top line of 20.42 crores with a growth of 16% on quarter basis. The EBITDA loss for the quarter is 35 lakhs only, and we are confident that EBITDA positive in coming quarter with the increase of scale of operation. Sanar is presently operating at 25% occupancy level, and it will increase gradually in coming quarter. In current quarter, 56% of the revenue contribution of Sanar is from the international patient, which is low compared to the last quarter due to festive season into the Middle East during the month of April and May, from where most of the international patients flows, and we are confident that in quarter 2 business from international patients will increase with the more footfall from the Middle East countries. Revenue from international business remain at 15 crore, which contribute 13 crores from Sanar and 2 crores from the Shalby in the current quarter. I am happy to mention that the acquisition of Sanar, our international presence in other geographies has been increased, and now we have 23 OPDs as a group across various international locations. I am very hopeful that with this strategic location, we will have to increase our international hospital revenue significantly in the coming quarters. At Shalby, our undivided focus has been on demonstrating our clinical excellence through successful execution of many diverse clinical surgeries in several of our hospital units. We also take pride to share that we have successfully completed 29 transplants, which includes 9 kidney, 15 liver, and 5 BMT during the current quarter of FY25. Our SOC franchisee business delivered an adequate performance into the current quarter. The total 329 surgeries has been performed at SOC units, both under the FOSO and FOSM in the current quarter. The total revenue from the FOSO business is at 2.6 crores, which has been grew by around 73% on YOY basis. Total revenue from the FOSO business is around 80 lakhs, which has been degrew by around 30% on YOY basis. In last quarter of the same financial year, the FOSO revenue includes the project consultancy fees of 40 lakhs in FOSO business, and by excluding that also, the FOSO business has been grew by around 12% on YOY basis. Our next SOC unit at Rascos is on satisfactory progress and is expected to get operationalized into the current quarter. We have been incredibly selective in our choice of potential partners. The many inquiries that we are receiving so far. To maintain the reputation of our strong brand, we follow a clearly defined process and strict criteria while making these selections. Looking forward, a strong sense of optimism about the seeing positive development into the upcoming quarter of this fiscal year. Our primary focus remain on utilizing our expertise and excellence in orthopedics with the goal of establishing more than 40 franchisee hospitals across India with the next 4 to 5 years. For our home care business, we have served around 7,302 patients in Q1 FY25 versus 7,695 patients in the last quarter of the similar financial year. Revenue from the home care business is at around 3.8 crore in the current quarter versus 3.7 crores in the similar quarter of the last financial year. As a part of our social commitment, we continue to spread awareness about the importance of health and well-being through various social media platforms and created 138 plus healthcare videos. We also conducted more than 65 healthcare camps and 155 plus healthcare talks across all our units during the last quarter as a part of various community outreach programs. Shalby also take pride in nurturing young talent through our Shalby Academy vertical with 1700 plus students registered in various healthcare programs during the current year. Our SAT implant business has delivered minimal EBITDA loss of rupees 66 lakhs in the current quarter due to marketing, sales promotion and other allied expenses incurred during the quarter for the upcoming products. Our operational efficiencies in improving quarter-on-quarter basis with the optimization of the procurement cost. The revenue is at the moderate level of around 26 crore in the current quarter versus 16 crore in the Q1 FY24 with the growth of 63% on YOY basis. With that, I will hand over the call to the moderator to open the forum for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you have any questions, please press star and 1. Our first question is from the line of Rohan Vora from Envision Capital. Please go ahead.
Hello, am I audible?
Yes.
Thank you for the opportunity. So, sir, my first question was on the implant business. So, what is our current COGS for the implant business?
Current CAGR for implant business.
So current cost of goods sold percentage for the implant business?
Oh, our current cost is in the range of about minus.
So the product to product is different, okay, because we have the different kinds of implant for the knee and hip. So it's all depend upon the product mix. But if you are looking after overall cost, including the overhead which has to be allocated onto the material cost, it is close to around 25 to 28% based on the product mix.
Okay. And just one more question on the ARPOB. So the ARPOB this year have been 43, this quarter have been 43,000 plus. So what contributed to the ARPOBs?
So there's two parts. One is Sanar has the very high ARPOB and Sanar have around close to 75,000 to 80,000 ARPOB. And in Shalby also, the high-end mix also contributed in terms of the ARPOB of this current quarter.
Right. I'll get back in the queue for further questions. Thank you.
Thank you. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Hello. Hi, sir. Thanks for this opportunity. Just wanted to check the Sanar Hospital now at a 26% occupancy level. What we have seen is more than 50% of their revenue is generated from the international patients. So, how to think about this in terms of profitability? See, knowing the fact that the margin profile of a business, which is heavily dependent on the international patient, is generally higher compared to the normalized margin mix. So, at a optimal occupancy also, the revenue mix from the international patients are likely to remain at this level or should improve. And if that would be the case, then what is the margin profile and how superior margin profile this hospital can generate compared to our blended margin that we have been reporting?
So thanks for the question. Mr. Naresh Kapoor, who heads, the northern region, he is also on the line. I think he'll be happy to take the question.
Yeah, thank you, sir.
Hi, good afternoon, everybody. So, coming to the question put up by Surya, we expect the mix of international and domestic business similar to what we have been doing right now, which is about 1/3 and 2/3. So 2/3 international, 1/3 domestic. It may, since domestic, we have recently, tied up with all the TPS, so it might increase a little bit, but no major difference should be expected. And with regard to the margins, yes, I agree with you that the margins are higher because of the higher end surgeries that we perform, and that also will be, in future also it will remain higher as compared to the other hospitals.
Okay. So then this can play a kind of margin booster role for the company as a whole.
Yes. True.
Okay. My second question is on, let's say, about the arthroplasty revenue mix. So obviously, with the more and more other therapies seeing a kind of a progress, the arthroplasty revenue mix has to some extent shrunk in this quarter on a YOY basis. So whether it is adding to the overall profitability, how should one think? Because in one way, the arthroplasty is getting complemented by the captive implants also. And that is in our forte. And now the other therapy-related services, if that is rising, then in terms of the margin, what change that it can bring?
So, this year you're right, arthroplasty business as a proportion to the overall business has gone up. So if you exclude Sanar, which has been a recent addition, we are at about 47% of arthroplasty work in this quarter. And yes, that has shifted the ARPOB of the company, for this quarter. In terms of, using our own implants, at the moment we are using only about 10% of our own implants in Shalby as a group, as we are in the works of trying to sort out our supply chain and ensure that we are able to get the product in sufficient quantity for us to be able to ship it out, because we are into the external market in the US, Indonesia, Japan, and other parts of the world. So, at this point of time, we are working on ensuring that, we do not fall short of supplies in the other regions. And, of course, we will be working in the next 12 months. We are very optimistic that about 70 to 80% of Shalby's consumption will be used. We will be using the SAT implants, within the arthroplasty business. In terms of the profitability, yes, the profitability of the arthroplasty is naturally more because, we are the largest player globally in terms of the volumes that we are doing. Having said that, some of the other specialties also are very highly profitable for us. I would not paint the whole thing with the same brush.
Okay. Yeah. Just last one question, sir, from my side. This is regarding the home care business. So, in terms of the number of patients served, what we are seeing in the presentation that there is a decline YOY. So, since this is the business which is kind of at its nascent stage and should be seeing a kind of a progressive or steady progression only, why the number of patients served should be declining?
So the home care business, basically, if you can see into the last all the quarters, the patient growth has also been there, and also accordingly we have a top line growth also. In this quarter, there is a slight reduction into the patient into the home care business, and there is not much of the improvement in terms of basically the revenue, but this is the one of the quarter where we have the low patient. But going forward, we are seeing the growth into that business, what we have projected.
Okay. So this could be an aberration just in terms of the quarter, or there is some sort of seasonality is there here in case of home care.
Some sorts, there is some operational hiccups was there for some period, but that will continue to grow, and we are growing very fast into the home care business, and this year we will grow into the similar line compared to the last year.
Okay. Yeah. Sure. Thank you, sir. Wish you all the best.
Thank you. The next question is from the line of Bino Pathivarampil from Elara Capital. Please go ahead.
Hi, good evening. Just a clarification on Sonar. In your opening remarks, you said there was a loss of 35 lakhs there for the quarter?
Yeah, loss of 35 lakhs on EBITDA level.
At the EBITDA level. Post or pre-Ind AS?
Pardon?
Post Ind AS or pre-Ind AS?
It's a post Ind AS. And just to reflect you, the Ind AS impact is coming in terms of the lease rental, which will go below the EBITDA level.
Understood. And what is the outlook here? When do you expect this to fully break even and may start generating profits at a PBT level?
Mr. Naresh Kapoor can take that.
Hi. So what we expect is that EBITDA level next quarter onwards, we should be looking at breakeven at EBITDA level, and overall by this financial year end or maybe early next financial quarter, we should be able to reach the overall breakeven outcome.
Okay. Great. Second, in your presentation, you give a standalone revenue and EBITDA. So, which all are the hospitals which come in standalone?
So, on the standalone business, we have all our hospitals, including our franchisee business. On the console, we are just including the Sonar business.
Okay, understood. And for the implant business also, would you please give some guidance on profitability? Because last year we had almost broken even. This quarter again, we have gone into a slight loss at EBITDA level. So what is the profitability outlook over the next few quarters?
Yeah. So I think the implant business is on the right track. If you look at it, there has been a significant growth upwards of 60% in the quarter versus the last year first quarter. The reason why you see that negative EBITDA is fundamentally front loading of a lot of marketing and sales activities that we are doing. We are preparing ourselves for a couple of new launches by end of this year and stuff. So there was a lot of efforts from that standpoint. And also because we were doing a lot of contracts and other things, we also had a slight upward expense on legal, which is, for this quarter, which was also a hit on the EBITDA. But going ahead, I think we are on track. So, like I said, our sales is growing and our COGS are going down. So you will start seeing quarter on quarter results starting to fall in place.
Sorry. Thank you. I'll join back with you.
Thank you. The The next question is from the line of Rohan Vora from Envision Capital.